All right. Welcome to our exclusive webinar on ultimate tax reduction strategies for real estate investors. Thank you all very much for making time in your busy schedule. I am Anchal Dwivedi, managing partner at Goldstone Capital Ventures, and I'm joined by my fellow managing partners, Dinesh Nayak and Shruti Dwivedi, as well as our guest speaker, Barry Neustadt. With a wealth of experience behind us, we have mastered the art of identifying underperforming assets with tremendous potential for value-add opportunities. We have successfully transformed these properties into thriving communities that are both financially rewarding for our investors and highly sought after by the residents. We have proudly acquired over 12 apartment buildings with more than 1,300 units across prime locations in Carolinas, Texas, Florida. We have exciting upcoming projects on horizon spanning various sectors such as assisted living, student housing, mixed-use assets, single-family residential project in Carolinas. This diversification allows us to continually explore new avenues for growth and deliver exceptional results for our investors. So without further delay, I pass on to Dinesh, who will be talking about our portfolio and latest acquisitions. Over to you, Dinesh.
Thanks, Panchal. Welcome everyone again. Thank you so much for joining us. Let me quickly go over our recent acquisitions. I know most of you are very familiar with these. This is Ivywood Apartments, 96 units. This is a Class B in Gaffney, South Carolina.
Sorry, can you share the slide?
What happened?
Can you share the slides, please?
Oh, did I? It's not showing up?
It's showing okay, now it's showing up, yeah. Yeah, good.
Okay. Yeah, this is in South Carolina. Let me know if it doesn't show up because I'm on a different laptop today. Yeah, this is Sweet Redemption in Dallas, just outside Cowboy Stadium in Arlington, Texas. We are actually converting this long-term rentals into short-term rentals to increase the revenue and the returns. So it was acquired last December and it's doing pretty well. Shaft Woods, this is a 40 townhomes, again, Class B, 1984 built in Charleston. This was acquired last March. And Cheslin Place, these are pretty brand new 98 townhomes, Spartanburg, South Carolina, just outside, just 15 minutes from the BMW plant. And they're adding another $1.7 billion of investment here in the Spartanburg area. This is our new construction flagship project in Winston-Salem. It's called One Salem Luxury Apartments, again, Class A. We are going through all the permitting process and the lending process is going pretty well. And then we have a couple of projects under contract right now, especially in student housing and assisted living area. This is in Nashville. If you really want to talk to us about these are active deals basically. So if you would like to talk to us, just let us, just please contact one of us. So with that, I will hand it over to Shruti.
Okay, thank you, Dinesh. And good evening, everyone. And thank you for joining us tonight. So whether you are a seasonal investor or just starting out, we are here to help you to make informed decisions, right? So the information, just calling out one quick thing, the information provided in today's webinar is for general information purpose only and should not be construed as legal, accounting, or investment advice. So having said that, it's my pleasure now to introduce Barry Neustadt from Madison 1031. Barry is a CPA and seasoned tax professional and tax director at Madison 1031, one of the nation's leading qualified intermediaries. Barry's background in public accounting, along with his real estate industry experience gives him a unique perspective on real estate taxation. In his role with Madison 1031, he assists clients regarding their tax-deferred exchange, including many major real estate tax questions. He specializes in real estate investment partnership and solutions for 1031s using creative tax strategies. He resides in Ocean County, New Jersey, with his wife and 5 lovely children. In his free time, he enjoys playing ice hockey with his friends. So before I pass the ball to Barry, just a quick housekeeping item. If you come across any questions during this presentation, then please drop your questions in the Q&A box, and we will go over that during the end of the presentation. So rest assured, all participants will receive the copy of today's presentation. So now, without any further delay, I will pass the ball to Barry.
Okay. So Dinesh, can you stop sharing your screen? I think I need to be able to see mine. There we go. And let me share my screen. Okay. Can everyone see my screen?
No,
I hope so.
yet.
Yes?
Not yet.
Not yet? Oh, sorry. Let's try it again then.
All right, starting.
Okay.
Cool.
So thank you for the wonderful introduction. I appreciate it, Shruti. And I'm glad to be here tonight and to hopefully educate everyone in some tax efficiencies that we can use in terms of real estate. Now, it's widely known that real estate is a very tax efficient way to invest. And we're going to talk about 2 major items or 2 major strategies, techniques that real estate investors use in order to achieve some of these tax efficiencies. So we'll start off with a little bit of, I'm here from Madison. Who is Madison? So Madison, we are a full service commercial real estate family of companies. We provide clients with kind of whatever they need. We help them from, obviously, our flagship company is the title company, where we provide title insurance to real estate, everything from houses to large commercial deals, skyscrapers, whatever it is. And that's kind of the way the company started out. And then we expanded to include other companies which help out which help our investors. One of them is Madison Specs, which is a cost segregation company, which we're going to talk about very shortly. Another company is Lease Probe Real Diligence, which helps for due diligence. Clients will come and they want an analysis as to what the cash flows were, how a certain property will perform, and things like that. And they can go to Lease Probe Real Diligence, and they'll provide that. We have someone wants to buy a shopping center, and they have 2 weeks for due diligence, and they need to go through some of these complex leases, and Lease Probe provides that support. So in addition to that, obviously, I work for Madison 1031. It's a tax-deferred exchanges, commonly known as 1031, because it's in the IRC section 1031, and we'll be talking about that as well in depth as we continue. So, but we'll start off talking about cost segregations. I'll explain kind of what it is, what it achieves, why we do it, who does it, and some details about that. So this first slide, again, goes through some of the various services, as Madison is an entire suite of companies to provide many different services in the commercial real estate arena. So what is a cost segregation in a nutshell? It's an IRS-approved methodology to perform a study that will analyze what the property has in it and parse out, kind of remove the different parts of the property so that you can depreciate the portions which are eligible for depreciation quicker. Now, this method is actually approved by the IRS. It seems like it's some sort of workaround or some backdoor help. This is actually explicitly approved for in the IRS, and there have been many cases under audit, and they and the IRS agrees with this. And the tax strategy is applicable to owners of investment property, whether the sponsors or the limited partners. Everyone benefits, because when you perform this study, the whole asset gets depreciated more quickly, and therefore everyone gets tax benefits from the beginning. And it creates increased tax benefit, generates increased cash flow, because if you don't have to pay taxes, then you can take that money and invest it or do something that you'd rather do with it, maybe go on vacation. So depreciation fundamentals. Now, without cost segregation, what happens is that you buy a property, and it's very simple. The commercial property is depreciated over 39 years, which means that you take the property, you divide it by 39, and you take 1/39th every year to depreciate, which reduces your taxable income. If it's a residential real estate, then it's over 27.5 years. And you can't expense it all in the first year, right? If you buy a property, depreciation is based upon the accounting concept of matching, the matching principle of matching the appropriate expenses with the appropriate income. And the IRS, in its infinite wisdom, decided that commercial properties last for 39 years. So therefore, if you buy a commercial property, you should equally spread out all of that depreciation over 39 years. Same thing with the residential real estate. You can't expense all of it in 1 year. That doesn't work, except under certain circumstances, but certainly not for a building, such as commercial real estate or residential real estate. So, and we're going to have a slide soon that's going to give us a lot more understanding. But what are the basics? How do we get to this cost segregation? So we start off saying that, hey, if you don't do a cost segregation, it takes a long time till you get the depreciation you're looking for. And if you do a cost segregation, you get it much more quickly. So what do we have to do? What do we have to accomplish in order that the IRS would say, hey, you did an appropriate study, which would allow you to take more depreciation earlier on in the life of your property? So this slide goes through, you have to have a qualified engineer walk the property, then they reclassify real property expenditures. Meaning, if you buy a building for $1 million, without cost segregation, you basically depreciate that $1 million equally over 39 years. So, and this study is going to say, hey, part of that stuff that you think is part of your building, that's actually not building. That's something else. So you're like, well, what is it if it's not building? So you bought a building for $1 million, but inside that building are different things that depreciate, that both for tax purposes and in real life, they actually wear out more quickly. For example, a parking lot. Parking lot, from the IRS's perspective, depreciates over 15 years. So if you buy a property and you don't analyze and figure out how much the parking lot cost you, the life for the IRS is going to be 39 years for the parking lot. Even though people who know parking lots will tell you that a parking lot can't last 39 years, probably lasts closer more to 10 to 15 to 20 years. So you wouldn't be getting the benefit without the cost segregation. But there are many examples of things that the cost segregation study finds that it can pull out. An elevator, for example. If you have a high-rise building, an elevator is depreciated much more quickly because, again, the elevators don't last forever. So they reclassify real property expenditures and they break out components that can be depreciated over a shorter life. This thereby accelerates the tax depreciation deduction, which means that you could have a property that's making money, right? The rent roll is covering all the expenses, covering the utilities, covering the mortgage, covering everything. And yet you're able to come out with a taxable loss for the year, which is fantastic. So you're able to kind of have your cake and eat it too, because you're making money on the property and yet you're not paying taxes. And the last bullet point, that it will produce significant non-cash cash deductions in the form of depreciation. So you're making money. You have the cash is coming into the property. You're receiving distributions, whatever other benefits you were having with owning the property. Yet the cost segregation is allowing you, for tax purposes, to say, hey, this property is not making money. The property might even be creating a loss, even though for financial purposes in real life, it's making money. So Here's the slide that I was referring to. And this is a very, very basic example, but it really drives the message home. The top part says without cost segregation, you buy a building for $5 million. You have to depreciate over 39 years. That equals to $128,000 deduction every year, which is nice, right? But that's not really great because, right, as we said, then very often you'll be producing net income for the year and you'll be paying taxes, which again, you make money, you pay taxes, not the end of the world. But if you could do both, make money and not pay taxes, that's even better. So that's when we go to the bottom of the slide. With cost segregation, we take the same building, that was purchased for $5 million, and we say, hey, the property was purchased for $5 million, but there are different aspects to that property. The building, the land, other things, that's the $4 million, that's the bulk of the purchase, and that, you're right, we had to depreciate over 39 years. But I'm gonna parse out, I'm gonna remove $1 million worth that the cost segregation study identified of different assets that depreciate much more quickly, such as, we mentioned parking lots and elevators, but even things like light fixtures and electricity wires and sewer mains, all these things can be depreciated much more quickly, which would produce a tax loss, even though financially you're still in the same spot. And as you'll see on the bottom, so we have $4 million over 39 years is $102,000 per year. Yet the $1 million, we take it over the first 5 years, which gives you an additional $200,000 for the first 5 years. So that means in total, in this very basic example, you would have year 1, 2, 3, 4, and 5, instead of having $128,000 of depreciation, you would have over $300,000 of depreciation, which could very well be the difference between having taxable income on the property and not for those 5 years. So who benefits from a cost segregation study? We call it cost seg for short. So it applies to all real estate owners who are current income taxpayers. So meaning it doesn't make a difference how you own it, right? You could own it through an estate or a trust, individual, partnership, corporation, LLC. Everything is suitable for a cost segregation study, meaning it's not like some tax credits are only eligible for people who aren't making enough money. Some aren't eligible if you're in a trust or things like that. Here, everything helps because, again, it's at the property level, and the property now creates a taxable loss, even though for financial purposes, it's making money. So what are the ideal properties for a cost segregation study? So new acquisitions, or newly constructed, renovated, or expanded facilities, right? Because all the stuff that you put in recently, though, that's kind of the juicy items that cost segregation can really get the most out of. And then facilities built or acquired within the past 10 years, which cost segregation studies have not been completed. Now, this means that if you owned the property for a long time, or if someone else owned it for a long time, chances are that the elevator, for example, might not have that value anymore that we could assess. We say, hey, that value, because the elevator might be on its last leg. The washing and dryers might be on the last leg, whatever the case is, or the parking lot might need to be replaced next year. So we don't have a lot of room to move if it's an older building, or if a cost seg was already done. So those would not be ideal candidates. So there is something called the catch-up depreciation look-back study. Now, this is an interesting feature which a lot of other things don't have, and some cost seg companies aren't familiar with it. Now, this means as follows. Let's say a guy says, hey, Barry, I heard this great presentation last night about cost segregation, and I bought a property in 2021, and we didn't do a cost segregation study. We didn't take accelerated depreciation, and I paid taxes back in 21. Is there anything you do to help me? And we actually have a very cool tool that can solve this problem, is that you can do a look back study, and you can catch up all the deductions all in 1 year, and you don't need to amend your return. And we file something called the 3115, which is an IRS form, which is a method change of accounting, change in tax method that goes with your tax return. And again, we've had tremendous success. We really have people that can just and literally make a lot of money, even though they're expecting to pay taxes. They'll be able to get refunds, and it can be very beneficial if you have a property that was not, that you didn't do cost segregation on, and that you could take advantage of now. And we're going to see in a couple of slides that we have a pre-screening process that you can basically just send us a property and be like, hey, I bought this property for this much in this year, show us the address. We have a program that goes in, looks at the property, and we can give you a ballpark estimate as to how much depreciation we could pull out of that property based on a cost segregation study. And if it's not worth it for you, then no harm done. And if it is, then it can be very beneficial to your bottom line. So I mentioned earlier that the IRS is okay with this cost segregation. And why are they okay with this? There are a number of cases. These are all listed. Everyone has on their handouts. These were cases where the IRS challenged the cost segregation study, and the cost segregation was approved. Now, recently in 2017, under former President Trump, there's the Tax Cuts and Jobs Act, TCJA, where he made this even better. How did he make it better? It used to be that you could only use new property to do cost segregation on. And he says, well, if you buy used property, right? Let's say you're buying used machinery or used washing machines for your multifamily, that still qualifies for a bonus. And that was in effect for 2017, 2018, 2019, 2020, 21, 20, and 2020 and 2022. Beginning in 2023, instead of 100% bonus, it's now at 80%. But it used to be 50%. It still gets you some benefits, and there is some rumbling in Washington that they're going to be extending it to 100%. So it's still something worth investigating. Now, bonus depreciation is actually slightly different than the accelerated depreciation, but for the most part, we marry them together in the study. We'll say you could take this amount of bonus depreciation, this amount of accelerated depreciation. You could take one and not the other when needed. And bonus depreciation is not allowed for property that you buy and sell in the same year, whereas the rest of the accelerated depreciation is. This is the same slide as you had earlier. This is a handy chart. Again, everyone has it on their handouts if they want to look at it further. Now, why should you choose Madison for a cost segregation study? So the reason why we're great is not to toot our collective horn or my own horn, is that we have a great combination of engineers who have experience looking at properties, doing cost segregations for many years of experience under their belt. And we have CPAs on staff that interact both with the property owner and ultimately with their CPA. When they have questions, have how to implement this onto the tax return, we have CPAs that be like, hey, this is what you should be doing. I've been on a number of these calls, but I mainly focus on the 1031 practice. But we have some really experienced, great CPAs that can help you out. And there are other companies that have engineers that don't have CPAs. You have CPAs, you have engineers, and we've got this great combination of both. So you want ideally you want the firm to confirm that you want them not to be doing something that's risky that the IRS would not allow, obviously. And we have actual IRS audit experience, meaning there have been times that the IRS comes in and says, hey, what are you guys doing with this cost segregation? Client calls us back, say, Madison, you brought this cost segregation study, and we've assisted them in their dealings with the IRS under audit and have succeeded in defending it. So, that's about as good as it gets, because we do everything from the study to defending it all the way to the end. And with real life experience, you're guaranteed to have a positive outcome. Now, this kind of goes through what the process is. There's a no charge feasibility analysis that I mentioned earlier. Basically, you could send us some very basic information, and we can give you a ballpark amount as to how much we think that we could save you on taxes from this building. Phase two, once you get the ballpark figure and you're okay with it, then you call us back. Then you contact us, and we go down to the property. We check it out. We take pictures. We compile a whole study, and we present it to you, along with everything that you would need to file your return and to successfully implement this cost segregation. So, and the reports are valuable backup for the CPA's tax filings, and many of them can fit right into the tax preparers programs, and we provide all the forms necessary in order to file. So in closing, cost segregation study creates an income tax benefit from estimate properties for anyone with income producing properties. And we'll pause here for a minute for questions. I see that there's one. Okay. Someone asked, at the end of 5 years, how is it that the $1 million be treated for tax purposes? Now, that's a great answer. That's a great question. And the answer is that the cost segregation study is not an absolute gain, meaning that it's all timing. So if you noticed on the earlier slide, if you front load all the depreciation of the cost segregation study, then in later years, you have less benefit. Okay. So you would have less benefit. So upfront you get immediate help, but later on you have less benefit. Now, obviously, if you sell it, then the year-to-year depreciation wouldn't help, but your adjusted tax basis obviously goes down as the years go on. So again, we're not creating any additional deductions. It's not like finding a deduction that you were missing, right? We're accelerating the deduction you were going to be getting anyway. We accelerate it into the early years, which offset the taxable income early on, which allows you to take that cash that was freed up and invest it and hopefully turn it into more money. I see someone says, do we have an example? So I'll be honest with you, I have many examples, but a typical cost segregation study is something like 40 to 50 pages. It's not so simple to break down, because what it actually does is it's the opposite of simple, right? They're complicating it by taking your building that you bought for $5 million in one shot and making it say, no, your building $5 million actually has a parking lot and an elevator, and it has stoves, and it has washer dryers, and it has doorknobs, and it has light fixtures. But what the concept is that it puts everything into buckets of depreciation years as to how long should be depreciated, and depending on its depreciation, that's how you'll get the benefit. Okay, now I'm very excited to proceed with the next half of the presentation. Which is about 1031, because as I mentioned, that's really where I spend most of my day. So what is a 1031, and would someone want to do it? The 1031 is actually over 100 years old. It was put into the tax code before most parts of the tax codes were in there. And the concept is as follows. If you have one property and you exchange it for another property of equal or greater value, the tax code says that this is exchanged and not sold, okay? Which means that if I buy a stock, I have shares in Apple, and I sell them, I no longer have shares in Apple, right? But if I exchange it for other shares in Apple, right? Instead of selling it, I say, hey, you have shares of Apple, I have shares of Apple, then in theory, it's an exchange and not a sale. Now, obviously, this used to be true, but it's not anymore for stocks. The only item which the IRS allows an exchange is on real property, real estate. So as we started off the presentation, that real estate has a number of tax advantages towards investing. So our first one was cost segregation, where you can accelerate the deductions in order to benefit in the earlier years, which it helps your bottom line. The 1031 is another great tool in the real estate tax efficiency arsenal. They say that since you're in the same spot, right? You used to own a property, now you own another property. They want to encourage you to be able to sell that and just exchange it for another one and not pay taxes on it. Why? Because the capital gains would be a significant reason why someone would not want to exchange. So which tax is deferred by 1031? So the tax due on profit earned on the sale of investment or income property, right? Meaning the capital gains. That is that's 15 or 20%. So that is deferred, right? Your sale price less your cost is your capital gains. That's deferred by doing a 1031. What else is deferred? The tax due on depreciation recapture that was taken by a taxpayer when the taxpayer owned the property, which is generally an ordinary rate, right? So that can be deferred by 1031 as well. So simply said, and again, this is really important to understand how 1031 works. You take one property and you exchange it for another property. Instead of selling it, you exchange it. By doing that, you don't need to pay taxes on the gain. So that means you could buy something for, our example was you bought something for $5 million. You took depreciation of $1 million over the first 5 years. Now your adjusted tax basis is $4 million. If you were to sell that for $5 million, let's say the same price that you went in for, you would have $1 million of gain. However, if you do a 1031 exchange, you can sell that for $5 million, take that $5 million and leave it with a 1031 exchange company, and then purchase another property for $5 million and not pay any taxes. But obviously, you have to have another property to replace it with. So who benefits from 1031 exchanges? So the whole real estate ecosystem, anyone who touches real estate really benefits from it, including brokers, surveyors, contractors, construction workers, lawyers, accountants, title companies, insurance agents. Everyone who touches real estate benefits from 1031. Why? Let's say I have a premier property in downtown Manhattan. Okay, it's worth $100 million. Now, I bought it 20 years ago, I bought it 30 years ago, I bought it 50 years ago, whenever I bought it, but my cost basis is much lower. If I were to go ahead and sell it, I would have a tremendous amount of tax due, which is nice. I also have a tremendous amount of gain. But if I don't need the money, what's compelling me to sell, right? Why should I go lose all this money to taxes when I'm comfortable with my building now? The problem with that is that this complacency of being satisfied with the building you currently have doesn't end up well for everyone else. Why? Because as supply goes down, then demand stays the same, then prices become unaffordable. And there are many people who make money off the transaction: lawyers, accountants, title companies, insurance agencies, workers. And there are also many other reasons why the tenants would benefit from an exchange, right? Let's say they have an old owner who's not interested in investing more money, but a new owner would be interested. So you're actually improving their quality of life by upgrading their property and making improvements on it. You can also, sometimes people want to consolidate. They have too many properties. They have properties all over the state, and they want to have just 2 or 3 properties they want to manage much more closely. Or they have only one property and they say, hey, this property is worth a lot of money. Why don't I go and diversify? Life transition, relocation. I often talk about a client we had in northern New Jersey, and she was actually an accountant, and she wanted to retire to California. And she said that without the 1031, so she ultimately sold, she had 5 duplexes that she sold, and that was kind of her nest egg that she'd been working for her whole career. And she said that she had a certain budget of what she wanted to retire on, she said if she had to pay taxes on it, she wouldn't be able to retire. So instead, she was able to sell her 5 properties, which were high maintenance, because she lived there and she was on top of all the landscaping and everything else. She was able to buy some triple net properties. I think she bought a different building in that was nearby where she moved to. But she was able to do all this only because of 1031. And if you don't know about it, people can make significant decisions without considering a 1031. And in short, this bottom point says that it allows the property to be used in its best and most useful way, right? By having the person who wants to own it, and having the person who doesn't want to own it anymore, not own it, allow them to exchange for something else, everyone ends up winning. So here's an example where a renter saves up, is ready to purchase a home, right? So let's say, right, many communities have some houses are rented and some houses are owned. Now, studies have shown that the transition from rental to ownership creates value to the neighborhood, right? The public schools are better, the transportation is better, the maintenance of the towns are better, everything's better, because owner-occupied people who own their home are more vested in their neighborhood. That's just what it is. But why is the owner even willing to sell? So we've had cases where it was only because the owner was able to do 1031 and not pay taxes on it. He says, okay, you want to buy your house? I'll buy a different house. I don't need to be in your neighborhood. But this renter, I lived there for multiple years and wanted to live in that neighborhood. They had their roots put down there. They want to keep their kids in school, and they were established that they wanted to stay there. So 1031 allows them to. Here's another example. Mom and Papa one's retired to Florida. They own 2 family homes in Patterson. If they had to pay capital gains tax, it would have cost 1/3 of their retirement funds to do that, and they wouldn't no longer have enough money to retire. Another case, their portfolio all across up and down the East Coast. They had 19 buildings, I think, and they wanted to consolidate into one regional area closest to their office, just easier to manage. The property managers didn't want to fly around so much anymore, and the other properties were sold to people who wanted to keep them. And here's another example, that a multifamily property that was constructed in 1980. The property owner already achieved ideal occupancy decades ago, and the property is kind of working. But we're in 2023, that's 43 years ago that he's owned the building, and those carpets aren't new anymore, and it could use a bit of a facelift. And the tenants don't want to move, but the tenants kind of don't like the state of their building. And again, the 1031 can compel them to move, and it can compel the owner to sell without incurring any tax liability. So to summarize, why should you exchange? You exchange the property you have to the property you want, and allows the property to be owned by the person who wants it. So we often have the question, which properties are eligible for 1031? Because we call a 1031 a like-kind exchange. Now, if it's like kinds, they have to be the same kind. So this is a bit of a misconception. Like kind just means that it has to be real estate. It has to be real property. You see on the slide, we have an office building, and then there's a factory, farmland, apartment building, and a single family home. All those are examples of real property that are eligible for 1031s. So so people should just be aware that it works on all types of property, and you can switch from one to the other as needed. So deconstructing the 1031, there is an important thing that some people that everyone should know. It only works on business or investment property. So if you want to move, if you want to sell your house and move someplace, that's not eligible for 1031. There's a different code section, 121, that has a $250,000 or $500,000 exclusion. That's a different story. But it has to be held for investment or business purposes. So the use doesn't need to be exactly the same, right? Like we said, it could be a farmland for commercial property, or it could be an apartment building for a single family home. It doesn't need to be the same exact, but it has to be like kind in that it's real estate or real property. And both have to be held for investment purposes. So types of exchanges. I'm going to go through briefly what the different types of exchanges are, and then we'll answer some of the questions. I think we're ending towards the end of the presentation, so I'll quickly go through some slides. The IRS envisions the 1031 as a direct swap, meaning the buyer has one property. Let's say I have empty land, and Dinesh has an apartment building, and I say, hey, they're the same value, and you say, hey, okay, I like yours, you like mine. We go ahead, we swap deeds on the same day. That almost never happens, but that is the ideal 1031, so to speak. The typical 1031 is actually something called a delayed exchange, where you sell at one point and you buy within 180 days, and 45 days after the sale, you have to identify the property. The funds have to come to the qualifying intermediary. That's what we serve as. Madison 1031 is a qualifying intermediary, meaning that at the time of sale, the funds come to us, and we hold it until you're ready to purchase a new property, and at that point, we send it to closing. So that's called a delayed exchange, right? Which means that instead of my exchanging with Dinesh, I can sell my property to a third party, and then I can buy Dinesh's property, or vice versa. We don't need to be only two people. We really have, as you could buy from a different party and sell from a different party, and we're not stuck to buying and selling directly. Okay, I see we have a couple of questions. Someone asked, does cost segregation apply for developing land for special purposes like building a sports field? So that's a good question. The question is as follows. land does not depreciate. So therefore, there's no depreciation or accelerated or otherwise on the land. However, if a person has land and then they raise money, find money, or however they fund their construction, and then they build property, they build building or sports fields on their property, those are eligible for cost segregation. In fact, some of the properties that do best with cost segregation are gas stations, mobile home communities, and golf courses. Actually, that's what brought that to mind. Golf courses have some great depreciation. Often there's a clubhouse that gets depreciated pretty quickly, and a lot of the maintenance, you don't see it when you're golfing, but there's sprinkler systems and there are water mains and there are all types of things that have to be upgraded and maintained, and a lot of those are eligible for accelerated depreciation. So the answer is definitely yes, it is eligible. It's a little harder for us to give an idea as to what it is before it's constructed. But if you would have, let's say a person's considering doing construction on their property, so you could give us a detailed architect's plan. We'd be able to figure out from there what would be eligible for accelerated depreciation. And then there's another question. Is it one-to-one exchange, or can it be selling one property and buying two properties? Will 1031 cover the scenario? The answer is absolutely. And it could go either way. So we have, and he says the example is he bought a townhouse for $200,000. He's selling it for $350,000 and buying two condos for $200,000 each, totaling $400,000. And that's totally fine. And they don't have to close it the same day. They just have to both close within 180 days of the sale. So let's say the sale is on January 1st, 2023. So you have 45 days from there to identify the replacement property and 180 days from then to purchase the replacement property. So again, so you could sell one property and purchase two properties, or you could sell two properties and buy one property. You could sell 5 properties and buy one property. You could sell one property, buy 5 properties. The amount of properties doesn't make a difference. And in fact, we very frequently have this where someone has, let's say they have a rental home or a building, factory, and they sell that, and they want to enter syndicated real estate. So the syndicated real estate might be a package of a portfolio of properties. It might be 2 properties, 3 properties, 18 properties, and they'll want to invest there, and that's totally okay. That definitely works. One thing I'll mention quickly is the identification requirements for 1031. The IRS says, hey, we're going to let you we're going to let you delay your deferral, right? You don't need to sell on one day and buy the same day. You have up to 180 days from the time you sell to the time that you buy. However, they do require you that you identify what you're going to replace within 45 days. And there are some rules to identification, but I think at this point we can, I'll stop talking, but but there are a number of rules. Obviously, with each exchanger that we have, we discuss with them. There's a email we send out, and then we remind them 20 days in, and 30 days in, 35 days in, and 40 days in, and 41, 42, 43, 45. As it gets closer to the deadline, we keep reminding them to make sure to identify the property so that they'll be able to have a successful 1031 transaction. Okay, there's one more question that I didn't see earlier. What kind of problems do people face when wanting to do a 1031? Excellent question. Now, in today's, right here in July of 2023, the most frequent problem that we're seeing right now is that people have a property and they have it lined up. They sell a property, they have their replacement property lined up, and the loan doesn't come through. The landscape for bank loans is not what it was just 6 months ago even, and it gets harder and harder to get the loans. And if you don't have enough cash to purchase it and you're relying on the bank loan, and then you need the bank to come through. So sometimes the bank will give you a commitment and they'll say, no, we back off, or that type of thing. We've had some unfortunate stories where people couldn't get their funding, or or the seller isn't able to go through. But to answer your question, what happens is that since you're in a tight timeline, everything has to fall in order, right? So if the bank says, yeah, we're willing to honor the commitment letter, but we need another 30 days to underwrite it with our attorneys and our analysts, so that can really hurt you with 1031 because you don't have that ability to close on time. That being said, we have had some success. We do have some tricks up our sleeve when necessary. If everything works besides for the bank, sometimes we have a way to to kind of massage the edges and to get it to work out in time. I see. What are your fees to manage a 1031 exchange? The fees are $1,200 if the proceeds are less than $2 million, and that's one property for one property. And if the proceeds are greater than $2 million, the cash proceeds are greater than $2 million, then the fee is $1,900. But the advantage, if you're paying the higher fee, so if you're paying the higher fee, then the exchanger benefits from the proceeds, the interest in the interim. And if not, really the lower fee is our compensating the interest that we earn during that time by lowering the exchange fee. Now, if there are multiple properties, so just that everyone understands on our end, so obviously we have to process things for every property, right? We've got wires and we have to, other communications and documents that we have to do for every property. So that's why we have to, that's why we increase it. So again, the basic fee is for one property sold and one property purchased. Additional properties are an additional fee, usually $350, maybe $450, something like that.
Barry, can I ask you a question?
Sure.
Generally, yeah, we come across these questions from our investors. The first question is basically, they invest 100K in one of the opportunities, and then they see the K1, okay, there is 50,000 paper losses, right? Mm-hmm. How can they apply those paper losses to the other income they receive from, it could be W-2 or other business, stock transactions, whatever. So can they do it, and how can they do it?
So the question is yes and no. There's a nifty form from the IRS called the 8252 that is called the passive activity loss limitation. And the IRS basically says that if you're passive in an investment, we will not allow losses in that to offset, let's say, W-2 income. However, the disposal of a passive activity can be offset by passive losses. So for example, let's say, let's say your real estate group has a successful sale in 2023 and everyone has a gain, which they're happy about because they made money, right? But they're not so happy about paying taxes. If they were to take that and go into a property, even as a passive investor, and then that new property creates, does a cost segregation study and has depreciation to create a taxable loss, that taxable loss does offset the taxable income. Again, generally a passive activity and an active and a non-passive activity cannot offset, but a passive gain and a passive loss can. So if you sell a passive real estate property and then you purchase a real estate, whether you or through the syndicator sponsor, buy a new property and that property creates tax paper losses in that same taxable year, you will get the benefit to reduce the capital gains that you had. And this is actually a strategy that we employ, kind of the marriage between the two halves of my presentation, is that sometimes the 1031 doesn't work out. Let's say the bank doesn't work out or the property falls through and the seller reneges. So often I have clients who aren't so happy. And sometimes, depending on the timing and the year and things like that, but if you sold in 2023 at a gain and you were hoping to do a 1031, now the 1031 is not going to work out, you can purchase another property not via 1031 if it's a good property for cost segregation, right? Like we said, like mobile park homes or things like that. But even most properties have some nice depreciation available. You can offset that, use that paper losses to offset your gain. So that will be kind of like a silver lining. Even if the 1031 didn't work out, the cost segregation come up, pick up that slack and still get to save a person from taxes.
Yeah. And also, can you explain what happens during sale, especially when we have to do the depreciation recapture? Can you explain that with an example?
Okay. Is that with a 1031 or without a 1031?
Without 1031, it's
Okay,
basically,
without 1031.
cost
So,
segregation.
right.
Yeah.
Okay. So it works like this, that the IRS says that the accelerated depreciation, if you took more depreciation than we normally allow, meaning the IRS says you're allowed to take bonus, for example, take bonus, take 100% in year one for items which are eligible for bonus. And that's totally fine. The IRS says, hey, that's okay. But the IRS says, well, if that was supposed to have a 5-year life and you bonused it, which means taking all or most of the depreciation in year one, if you did that, that means that you offset ordinary income with your depreciation. Therefore, right, so again, there are two buckets. There's passive income, which is generally capital gains rates, and then there's active income, which is at ordinary rates. So the IRS says, hey, when you did that, you were able to, whether you did or didn't, you were able to utilize that to defer your, actually to offset your income, your ordinary income. So therefore, we want to recapture. Recapture means we're going back after it, so to speak, right? We see that you sold that property earlier than we allowed you, earlier than we expected you to. And therefore, we're coming back at you and charging you ordinary rates on that depreciation. So again, and I'll give an example. A simple example would be someone purchases a property, gas station, buys the gas station property for $1 million. We're able to, with the cost segregation study, we find that there are assets subject to bonus worth $200,000. Okay, so you bought for $1 million, you take $200,000 depreciation year one. And let's assume all that's bonus. So the next year, a guy comes knocking on your door and says, I love your gas station. I need to buy it. It's got the best location. I need that gas station. I want to buy it. So you're like, okay, what are you willing to give me for it? $2 million. You're like, wow, $2 million. I bought it a year ago for $1 million. I'm in. Okay. So you're like, okay, $2 million. Let's do it. So you go and you sell the gas station for $2 million. Now, the way the IRS looks at this transaction, so you bought it for $1 million. You took depreciation of $200,000, and now you're selling it for $2 million. So your adjusted tax basis is $1.8 million. Now the IRS says, okay, you're selling it for $2 million. You bought it for $1 million, but the depreciation you took is subject to recapture. And when we recapture, we look at that depreciation separately, and it's on a different line on the return on the K1s. And therefore, we'll have ordinary, therefore, the $1 million, right? You bought it for $1 million, you're selling for $2 million. That first $1 million, that's capital gains rates, 15%, 20%. That's gonna be capital gains rates. However, the $200,000 of recapture, meaning that we see that you took an asset that we thought was gonna last for 5 years, you depreciated it all in year one, and now you're selling it before the 5th year. We're gonna take that at a not punitive rate, but at the benefit rate that you got it at the ordinary rate. Now, for a passive investor, the recapture still exists, but they'll generally end up in the same spot because they didn't take the deduction in year one. But there could be repercussions either way.
Okay, good. Thank you.
Barry, can I ask you one question?
Sure.
This is for 1031 exchange, for the properties which are held in either partnership or corporation. Mm-hmm. So when we buy a property from that 1031 exchange, do we have to enter with the same partnership structure?
So that's a great question. The answer is yes and no. There is a principle called same taxpayer, right? That the IRS wants to say that you could only sell the property if partnership or corporation A sold the property. Then that same partnership has to buy the replacement property. Otherwise, it's not an exchange, right? If I sell something and my brother buys it, replaces it, That's not an exchange. So if company A sells and company B buys, that's not the same thing. So you're like, well, but what if I need new investors? What if things change? It's a bigger deal, it's a smaller deal, different location, people want in, people want out. Now that's something that that I personally deal with every day. That's really where my specialty is in partnership taxation, and these are the things that we deal with on a day in day out basis. So to answer your question, the tax partnership as an entity has a fair amount of flexibility in terms of adding members and losing members. So we can very often work out a solution to allow the partnership to gain or lose members during the course of the exchange. So just to recap, the answer is yes and no. The answer is no, that it has to be the same taxpayer that buys, has to be the same taxpayer that sells. But yes, that we do have some flexibility in a partnership or a corporation to add or remove members, as long as it's not, as long as not more than 50%, to add and remove members in order that we have the right people in the right property on the replacement.
Okay.
Okay.
Thank you.
I have Tom here raising hands. Tom, I think you can speak out your question. Tom, you can talk.
Tom, you can unmute and you can talk. Okay.
Yeah, he is muted. Okay. Yeah, any other questions from anyone?
Tom, feel free to, my email's in the slide deck. Feel free to reach out via email, or we can arrange a call.
There's one question just
Oh, I
came.
see. Mhm.
Yeah, just want to address that.
Okay, if you invested in one of Goldstone's property and when that is sold, can we reinvest the principal versus profit of Goldstone in another offering? Does this need a 1031 exchange? So on this one also, the answer is definitely maybe. It's kind of yes and no. So if Goldstone is doing a 1031, that's the easiest that's the easiest method, because the whole entity or some version of that entity, as we do have some flexibility into the in partnerships, will buy the replacement property. So then that's fine, you're riding along for the ride. But your question is, let's say Goldstone or a different sponsor is selling one property and they're not doing a 1031, and you want to invest that in a different property, whether with Goldstone or with a different syndicator, right? So again, let's say the original syndicator is not doing a 1031 exchange, and you as an investor want to do 1031 exchange. So again, that's something that we really deal with very, very frequently on a day, really on a daily basis. And again, we have some solutions. We have some solutions, whether in the partnership tax field or there's something else called tenancy in common, which often when you have multiple 1031s in the same property, then we do something called tenancy in common structure. And so there are ways to do it, and that's really, again, that's really what we do at Madison. That's what I do day in and day out. Is I get a call from someone like Dinesh, and they're like, "Hey, we're selling. Half the investors want to continue, half the investors don't want to continue. How can we work this out that the investors that want to continue stay in, and the people who don't want to can get out?" And we have a few tricks up our sleeve as to how to accomplish this. But every situation is slightly different. And that's really, again, that's really where having an experienced, knowledgeable, qualified intermediary comes into play, because they can really guide you through the whole process and help you find situations that you might not know about. So I was at a law firm last week, and they I met with them. It was actually outside of the in the Midwest, and they're like, "Oh, I try to whatever clients say, we try to have them go to Madison." I was like, "Why do you choose Madison?" He's like, "Madison's team understands any complexity or anything that we're trying to do that's off the beaten path, right? Anything creative that the lawyers and the accountants are trying to do in order to make this 1031 work. If you don't have an experienced team handling the exchange, then they might not be able to understand it. sometimes we've had cases where someone came to us and like, hey, could we do this? I'm like, yeah, sure, of course we could do this. Well, I asked a different time they were coming, they said I couldn't do it. So, and I'm glad to be able to say, yes, you can do it. And B, I'm able to show them where in the tax code or where in the regulations it says that this is fine, or we can tell them, hey, we have a legal opinion that says this is okay. And, other companies that don't have that experience kind of just, kind of shrug their shoulders like, oh no, this is not going to work. So, one of the more rewarding things about my job is when I'm able to find something that solves people's problems and help them out.
That's great. I think we are almost running out of time now. But
I think
yeah, this was a great session, Barry. Thanks for throwing all the nuggets. It was very, very informative.
Oh, my pleasure. My pleasure. I'd be happy to return if you ever want me back.
Absolutely. Thank you so much again for your time. And I know it was a short notice for you too. And for
Yeah,
all.
my pleasure. So it seems like you have a great crowd here. It's nice to meet everyone virtually, at least.
Absolutely.
Thank you.
All right. Thanks, everyone. Have a great night and enjoy your summer.
Thank you.
Thank you, everyone, for joining. Thank you. Bye.
Thanks, everybody. Good night.
Good night.